Hello, everyone, and welcome to Confident Compounding with Corey Kramer. I've had a lot of requests lately to revisit Constellation Brands, ticker STZ. So that's what I'm going to do today. As always, is not individual investing advice, just how I analyze stocks. Okay, so Constellation is a beverage maker, alcoholic beverages, wine, liquor, beer, right? Been around a long time, and they have a ton of different brands. They always seem to be changing where they're selling off one portion and then buying another one and stuff. So I don't know exactly what all their brands are now. I know Modelo and a few other ones have been more popular in the past couple of years than before. But that's kind of where we're at here with Constellation. So to review the last video, which came out in May, I bought this stock in February of 2025, pretty much right down there near the bottom, it looks like. During that bottom, not the bottom. At the time, we hadn't yet had the sell-off related to tariffs and so forth in April. So I had a lot of cash, and I do have a weekly picks service over on Patreon. So each week I find some stock to buy, even if there's not a whole lot in the market. If it's not perfect, I try to find the best one that I can find at that particular time. And that's what I buy. That's $25 a month. I also have a free tier on Patreon. If you want to check that out, those links are in the description. What I'm about to say is not a great ad for the weekly picks, but they've actually done awesome. Almost doubling the return of the S&P 500 on average this past year. We're going to hit a year. I think the 52nd pick will come next week. So, and at the end of this quarter, I'll review the returns. I won't show you what stocks they are on the YouTube channel, but I'll show you how they've performed. But this particular one has not done well. It's down about 20%. But my thinking at the time was the market was pretty high. This is in February, I think late February. And so there wasn't anything that seemed particularly cheap at the time. This has generally been a defensive type of business, and it was trading pretty cheaply. And the hope was that, tariffs and things would be temporary. That at the time, these 2026 earnings were going to be expected to be over $14 a share. So they have disappointed for sure. In fact, I would say the stock price decline probably from where I bought it actually makes sense based on the earnings miss. So they are not meeting expectations that what they had back in February. So all this was known when I made my last Constellation video in May on the YouTube channel. Except for the stock is down more now. So now I only took like a 0.5% weighting, like portfolio weighting. So it's a small position. And I didn't want to add more just because the stock price fell, because it wasn't really clear what sort of downturn we were going to have. My purchase was based on this 2020 drawdown. So that's what this was based on. And I did go back and watch part of my other video to see what I said. And so I'm not going to contradict myself too much here. But I noted that it could be more like the 2008 downturn when it's all said and done, which is much worse. Okay. Like even now, what's the PE? 10? Like back then it got down to 7. Okay. So that's still like 30% lower, right? All other things being equal. That assumes earnings don't keep falling, which they probably will the way things are looking. So the question now is, okay, is it a buy now that it's cheaper? And am I selling my position? Maybe might be a question some people have. So I'm just holding this right now to give it a little bit more time to play out, and we'll kind of see what happens. It's not looking very good, I don't think. Now for new money, because these earnings are falling, I would say that I would wait until there's some sort of positive momentum for the stock. which will probably precede the earnings bottoming and coming back up again. Because Wall Street can go look at beer sales and alcohol sales ahead of time, like with Nielsen data and things like that. So they're going to know a little bit before the earnings come 3 months later or whatever, whether sales are picking up or going down, and the stock price will react to that, most likely, right? So when I bought it, I was probably looking around, since that's 20% lower, this is probably around the price that I paid for it. But now that, and this is based on the 2020 recession, but now because remember back then these earnings here were expected to be like over $14 a share. Well, now they're only going to be like 11. So much worse. And what that does is whereas this might have been around 8% or something at the time, this is a 10-year earnings CAGR expectation. It's based on earnings growth, which is 5.45%. This is probably actually going to be lower too now that earnings are falling. I haven't readjusted it yet because they could come back, right? And they're just projections. But overall, this buy price based on just what we've seen right now is $105 a share. So using kind of my normal methods. That doesn't include this isn't designed to buy during a recession, which is basically what earnings are going through right now. But if you're just going to use the basic valuation, if you assume they can earn that $11.46 this year, grow 5.5% after that over the next 10 years, then the stock price would still need to fall another 20% before it would be a buy using those assumptions. So it doesn't look cheap just because the stock price has gone down. Just if you're just using basic earnings based analysis, sure, the current PE, or this is the blended PE, came down, but if they're only going to grow 5% and they're only going to earn $11.46, maybe less than that when it's all said and done, then that's not really super cheap, actually. So the question is, if by the time earnings actually do bottom, the stock will bounce back. So if you're just waiting on the fundamentals to change, you're not going to catch it probably at a great price unless it goes much lower and it's a bigger, deeper cycle and they eventually come back from it. So my suggestion would be to look at the momentum of the stock and wait for some kind of a bottom. So in my spreadsheet, I have grades for those that I get from Seeking Alpha, and they have an F right now. So bad. F is bad if you're not from the United States. On a 12-point scale, it's at the lowest, okay? Momentum wise. But another simple way to do it is to just use the 200-day simple moving average and wait for the stock price to rise above that. And when it does, that's a sign that there could be a technical bottom that's kind of being put in, or Wall Street thinks that in 6 months earnings are going to get better. Okay. And they'll probably be ahead of Wall Street will probably be ahead of the actual earnings, kind of just like they were ahead of the earnings decline here, right? Wall Street did see it coming. I had thought that it was priced in, but then it ended up being worse than Wall Street even expected. And so the stock price went lower. Bigger picture, alcohol. Now looking out at the world, of course I'm a Gen Xer, so we're known for drinking and stuff, but you would think people would be drinking more, right? But they're drinking less. I don't know, maybe they can't afford it. Maybe younger people can't afford it. And I think more people are, using the marijuana, the THC, in different forms. And so maybe they're drinking less because of that. Because it's just not a Constellation thing. If you look at any of the alcohol companies, none of them are doing great, and most of them are struggling similarly. So that could be a broader trend and we also have the weight loss drugs, which tend to reduce alcohol consumption as well. Boomers are getting older and they're not drinking as much, really old. So they can't almost unless they want to cut their lives short. So there's some structural reasons, I think, where probably the alcohol industry is going to have to go down make a bottom, just as a group, and then come up from there. So in a situation like that, you probably don't want to be buying on the way down, because the down could be a long way. If we look at Brown-Forman, which is one I warned people about for years, it was too expensive, and I'm sure I've made videos on it because I like to point out when I'm right sometimes. So it's down 66%, right? Well, their earnings have basically gone nowhere. They're like less than inflation, like earnings growth. But they haven't like lost money or anything. It's just that people were paying so much for it. Because they had paid like a consistent dividend, and they had kind of a long run here with just solid, decent, okay earnings growth. Like it wasn't great. But once this kind of negativeness sets in, all the people that bought this stock on the way down, thinking it was getting cheaper, like if you used the normal PE, right, you would have been buying right here when it was below it. Maybe you waited till here. Well, you would still be down 35% in just like a year. So you want to be careful when a whole industry is going through a big negative reset of buying too much on the way down. I'm not so much against like nibbling. Even if a person wanted to come in here with a 15 PE, and this is not a buy, but I do, it's kind of like Constellation. It's like, well, it is cheaper now. It's like it's not super crazy overvalued like it was. So if they pulled out a year with, and this goes for Constellation too, if 2 years from now they have a year where earnings grow 20%, the stocks will probably skyrocket. But we don't know what base that's eventually going to happen. So you just want to be careful when it comes to trying to buy these on the way down, because everybody basically that bought this stock since in the past, I don't know, what's it at? 27. So I almost picked it. So 2012, what year is it now? I don't know. If you bought it in the last 12 years, you're underwater. And that's, people were paying like a 27 PE for 8% growth, which is too expensive back then. Even back in 2012, it was too expensive. You know, during the Great Recession, that was a 13 PE. That's getting close to that now, right? That was a fair price to pay. You could have got a solid 9% return from a very stable business, right? You wouldn't have to watch it too closely. Now we have these industry kind of changes coming, or happening, and we don't know where that's going to bottom. But I doubt people are going to quit drinking altogether, and the small players are going to go broke. Okay. So there's breweries closing every single day and going bankrupt every single day. And so eventually that's going to leave the stronger players, which are going to be these guys that have been around 100 years. They're going to be left standing with less competition, but that whole process takes a long time. So I don't think they're going away, but 50% downside from here is not impossible. I mean, for any of these type of stocks, because we don't know where the bottom's going to be. All right. If you found this useful, despite kind of being a negative, not optimistic, but I will say you're not going to have very many people come here on YouTube. I don't watch very many other people's videos, but I just know how things work, and say, you know, I bought this back in February. You shouldn't be buying it yet, you know? So hopefully you can respect that a little bit and know that I'm not going to come out here and feed you a bunch of crap just because I bought something. I'm not going to tell you that it's still a buy when the fundamentals have deteriorated and there's no sign that they're going to change in the next, year. So if you enjoyed this, hit the subscribe button if you found it useful. Head over to Patreon, join my free tier there. I post more videos there. And then I have the services too that are paid services as well. All right, thanks for watching. I'll see everybody later.